Dividends can be a useful source of income. Like all investment strategies, it's important to understand dividends thoroughly before investing in them. A dividend is a payout from a company to shareholders. Dividends are most commonly issued as cash, but sometimes can be in the form of shares. We're going to focus on cash dividends in this video. Remember that while dividends can be a source of consistent income, it's important to understand them before just jumping in. Dividends are discretionary. That means that companies don't have to pay dividends, and they can change their dividend payouts at any time. Since dividends are paid out of a company's profits, it's a good idea to research properly the profitability of any dividend-paying stocks. There are a few metrics that investors can use when evaluating whether a company is likely to be able to continue paying dividends or not. First is the payout history. Does the company have a long history of paying consistent dividends? Second, does it have a history of increasing dividends? Third, what is the payout ratio of the company? The dividend payout ratio is a measurement of how much the company is paying out in dividends as a percentage of profits. To calculate the payout ratio, you take the dividend per share amount and divide it by earnings per share. A company that earns $2 per share and has a dividend of $1 has a payout ratio of 0.50. This company currently should have no problem sustaining its dividend. A company that earns $2 per share with a dividend of $3, well, it's not as likely to be able to continue paying dividends. Generally speaking, the lower the payout ratio, the more safe the dividend is considered to be. Dividend yield is how much the stock is paying out as a percentage of the stock price. You get this percentage by taking the dividend and dividing it by the current stock price. For example, a $50 stock with an annual dividend of $1 has a 2% dividend yield. It can be really tempting to chase the stocks that have the highest dividend yields, but a high yield can sometimes indicate that a company's in trouble. In that case, the stock price may drop, or the company may have to cut the dividend. Watch for unusually high yields for the industry, excessive company debt, high payout ratios, low cash flows, or any other problems with the business. When investing in dividend stocks, there are several dates that you should be aware of. The declaration date is the date that the company board of directors authorizes the dividend. The record date is the date that you need to be a settled shareholder to receive the dividend. The ex-dividend date is the first date that the stock begins trading without the value of the dividend. And the payout date is the date you receive the dividend. In U.S. markets, current trade settlement time for stocks is 2 business days. That means that to receive the dividend, you need to purchase the stock at least 2 days before the record date. The ex-dividend date is the day before the record date. Some traders try to use dividend capture strategies. This is a strategy where they'll buy the stock before the ex-dividend date, and then they'll sell it on or immediately after the ex-dividend date. While this strategy may work, there are a few limitations to be aware of that could make the returns significantly lower than expected. Typically, stocks discount the value of the dividend on the ex-dividend date. In other words, if a stock issues a dividend of 50 cents, the stock will trade 50 cents lower on its ex-dividend date. Brokerage and exchange fees can impact profitability, and tax implications for dividends can change if the stock is held for only a short period of time. Well, speaking of tax implications, dividends can be taxed in 2 different ways. Some dividends are ordinary dividends, and some are qualified dividends. Ordinary dividends are taxed as ordinary income, and qualified dividends are taxed as capital gains. While most domestic corporations are taxed at capital gains rates, real estate investment trusts and master limited partnerships are commonly taxed at ordinary rates. It's a really good idea for you to research the potential tax implications of dividends with a qualified tax advisor or service before investing. Dividends can be a useful source of income. Like all investment strategies, it's important to understand dividends thoroughly before investing in them.